Can we classify the loan with variable interest payments and collateral at amortized cost? Hello, ladies and gentlemen, this is Sylvia of cpdbox.com. Welcome to this video with my answer to one of your questions. And if you have your own question that you want me to respond, then send it to me via our website. And if it's useful for many people, I will answer it in a video like this one. Today's question comes from Anna from Russia, and let me read it. We provided a loan with a variable interest rate, and there is a limitation for maximum and minimum interest rates to be paid. Will this feature prevent this loan from passing SPPI test, solely payment of principal and interest? Or is it still possible to classify this loan as at amortized cost? And the question goes on. Are there any limitations of SPPI test passing on the basis of a collateral type? Implementation guidance in IFRS 9 specifies that in some cases, a financial asset may have contractual cash flows that are described as principal and interest, but those cash flows do not represent the payment of principal and interest on the principal amount outstanding. For example, this could be the case when a creditor's claim is limited to specified assets of the debtor or the cash flows from specified assets. Could you please tell us some examples in order to clearly understand what does the standard mean in this case? Because it is a usual practice that loans are collateralized by particular assets, for example, mortgage or other collateral type. End of the question. Okay, got it. So let me first explain what the main issue is here. Under IFRS 9, you can classify the loan at amortized cost only if it meets two criteria. Number one, it's business model test criterion. So it says that the objective of the entity's business model is to hold the financial asset to collect the contractual cash flows and not to sell the instrument prior to its contractual maturity to realize its fair value changes. So if you're a bank that normally creates loans and you normally collect the repayments of these loans, and you're not selling or otherwise trading with these loans, well, then this criterion is probably met. And it's not really that difficult to assess it. We will focus more on the second criterion, that is cash flow characteristics test. The contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Nothing else. That's the abbreviation SPPI, solely the payments of principal and interest. So now, if the loan meets both criteria, then you can classify it at amortized cost and set up a nice effective interest method table and recognize interest and repayment of principal over the life of the loan in line with that table, which is simple, easy, and clean. But what if the loan fails to meet one of these criteria? Well, in such a case, no amortized cost, but you have to classify the loan at fair value through profit or loss. And that is additional burden and completely different accounting because you have to set the fair value of such a loan at each reporting day, which is not automatic, and it could be difficult and challenging. And as I've said earlier, it's quite easy to assess the first criterion, the business model, but it could be challenging to assess the second one. So let's get back to the question. Does the variable interest loan pass contractual cash flows test? Well, the answer is it depends. The interest must reflect only the payment for the time value of money and credit risk, nothing else. If there's something else included, then it would not be okay and the test would fail. Well, let's specify some examples. If the variable interest loan provided by the European bank is, let's say, LIBOR 6 months plus 0.5%, in other words, it is tied to some interbank market rate and nothing else, yes, that's fine because the cash flows from that loan are solely the payments of principal and interest, and it doesn't matter whether it's variable or fixed interest. If there is some limit on the amount of interest to be paid, well, some cap with maximum interest or floor with minimum interest, It reduces the variability of cash flows from the interest paid. And if this is the only reason for cap or floor, then it's okay and the test is passed. And that's also the answer to Anna's first question. Then we can have the loan that carries interest linked to inflation. Well, what to do in this case? Well, if the terms say that the loan carries an interest of 5% increased by the inflation index each year, then it's okay, because linking payments of interest and the principal to inflation index kind of updates the time value of money to the current level. That's okay, and this would pass the test. It is very similar with loans with collaterals. If the loan is full recourse, or that's fully backed by the collateral of the borrower, then yes, we can say that this collateral does not affect the loan classification and the loan can still meet the contractual cash flows test. Now let me specify a few examples when this test is not met. When you have some non-recourse loan secured by some collateral, it might not pass the test. Why? Well, non-recourse loan means that if the debtor defaults, he's not able to make the payments anymore, the bank can take the collateral, like sell the property and take the cash to collect the loan, but the bank has no right for any further compensation, even if the collateral does not cover the full value of the defaulted amount. So in this case, logically, contractual cash flows can be limited to the value of collateral, and that is not meeting the contractual cash flow test. Just don't panic if you're a retail bank providing mortgages to individual clients. These are full recourse in most countries and in most cases, so they pass the test. Another example of not meeting the test are loans with interest depending on some cash flows from collateralized assets. So let's say the bank provides a loan for the construction of apartment house. It is collateralized by the land under that house, and the payments of cash flows can be increased or decreased depending on the sales proceeds got from the sales of apartments. This does not meet the test because the cash flows include also other component, share on profit, and not only the payment of interest and principal. Another example. If the future repayment of loan depends on the movement in market price of collateral, well, that's the problem too. Another example of loan not passing the test is convertible loan to fixed amount of ordinary shares. So if the bank provides a loan to some big company with option to convert this loan into ordinary shares instead of taking repayment, that's the problem, because the cash flows are not only for the repayment of principal and interest, but they are adjusted for the conversion feature. Again, this requires careful analysis, because if the loan is convertible to variable amount of shares, and the unpaid amount of loan equals to the fair value of total shares converted, then that's okay. It's not black or white. What about leverage interest rates or linked to leverage inflation index? For example, what if the loan carries an interest of 2 times 3 months LIBOR, and that's leverage because it's a multiple? That's a problem too, because the variability of cash flows steeply increases, and these cash flows do not have the economic characteristics of interest, while reflecting just time value of money or credit risk. In general, this is for a long debate, and I just gave you a few examples of the most common cases, but remember, you always need to assess whether the cash flows are only for the principal repaid and interest, and whether that interest reflects just the time value of money and credit risk. Let me remind you that this information is not a substitute from a professional judgment of CPA of your own situation and circumstances, and you should consult a CPA or other qualified professional. So this is it for this video. For more content like this, please visit cpdbox.com, share this video with your friends or colleagues, subscribe to our free newsletter and to this channel, and get more insights like this one. Bye bye, and thanks for watching.